This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Investment appraisal under uncertainty. So we've dealt with investment appraisal calculations in a previous chapter, but one problem always is that we're basing our decision on estimated cash flows. If all the cash flows are certain, then fine, the NPV we accept or reject, but in real life, of course, they are only estimates. And if any of those cash flows turn out to be wrong, then potentially our decision could have been wrong. And there are a couple of things you could be asked to look at, but the first is something called sensitivity analysis, which you should actually heard the word before in other contexts, but here specifically in the context of discounted cash flow. And to explain what it is and how we calculate, can we go straight to exercise 1? Dinah has set up a new company and estimates that the cost of capital is 15%. Her first project, now there are a lot of 15s here, so be careful. Her first project involves investing in 150,000 of equipment with a life of 15 years and a scrap value of 15,000. It'll produce 15,000 a year, generating a contribution of $2.75 each. And she thinks there'll be additional fixed costs of 15,000. Now, although normally, part A is the project worthwhile, we're going to calculate the NPV. Usually, we're talking about short projects, 4 or 5 years. Here it's 15. Well, I'm not going to set up 15 columns. Let me just set up the flows one by one. We're going to we'll have equipment with a cost, an outflow of 150,000. It's going to last 15 years, and every year will produce 15,000 units and will earn $2.75. And so the contribution each year, 15,000 times 275, 41,250 per annum for each of 15 years with an annuity. There'll be extra fixed costs of 15, well, extra incremental, they are relevant. But again, it's an annuity. It's 15,000 a year, again for 15 years. And finally, back to the near the top of it, the scrap value in 15 years' time is 15,000. So there are the cash flows. Discount at, what was it? 15%. The present values, well, the cost is 150. For an annuity, use the annuity factor. So 15 years at 15%. The annuity factor is 5.847, giving the present value of 241,189. Assuming the fixed cost, 15 years, annuity 15%, 5.847. Present value of them, 87,705. And the scrap proceeds. This is just an individual flow in 15 years' time, so the ordinary factor for 15 years at 15% is 0.123. $1,845. So the net present value, 241,189 plus 1,845 minus 150,000 minus 87,705. I get 5,329. And so in any normal question, Since it's positive, we would accept. Finished. However, as I said at the beginning, the problem is those are all estimates. And if any of those estimates turn out to be wrong, the NPV will be different. As long as it's still positive, we are still happy to have gone ahead. But if ever things change to the extent the NPV becomes negative, then of course we will have made the wrong decision. We should have rejected. And the question says, calculate the sensitivity to change of, number one, the initial investment. And all we mean by sensitivity is what percentage change can we afford to end up with a net present value of 0. And think about that cost. If the cost increases, suppose the cost increased by 1,000. If everything else stayed unchanged, if the cost goes up by 1,000, the NPV goes down by 1,000, but it would still be positive. And so we're still okay going ahead. If you went up by 2,000, NPV goes down 2,000. Still positive, still okay. But if the cost were to go up by 6,000, NPV falls by 6,000 and becomes 0. I'm sorry, becomes negative. And of course, if it's negative, then we would have wanted to reject. And so break even, in a sense, is when the NPV becomes 0. So we say, what percentage change can we afford before we get an NPV of 0? And for the initial cost, we can afford the NPV to change by 5329 to get to 0. Well, we can afford the cost, therefore, to change by 5329. In percentage terms, a change of 5329 on a cost of 150 in percentage terms, I think it comes to 3.55%. And strictly we should put a sign to it. Cost, surely, I'm only worried if the cost was higher by 3.55%. If the cost was lower, then it makes the project even better. But that's the sensitivity of the cost. It can increase by up to 3.55% and it's still worth doing. If it increased by any more than 3.55%, then we've got a problem. It would be negative. Well, that was an easy one. Let's do the next one, the sales volume. Now think about this, because then I can actually give you a rule. What's going to happen if the sales volume changes and everything else stays fixed? So cost stays at 150, fixed overhead stay at 15, scrap stays at 15. What will change is the contribution. That contribution was 15,000 units at $2.75 each. And just think this through. If the sales volume were to fall by 10%, that would fall by 10%. And if that fell by 10%, so too would the present value. If the volume rather fell by 5%, units fall by 5, contribution per year falls by 5. Discount, the present value falls by 5. Well, we can afford the present value to fall by 5329. And so the sensitivity of the volume we take the NPV, we divide by the present value of, in this of the item affected, as a percent. So NPV 5329, we can afford it to fall by up to 5329. The present value that's going to change is that 241. For every percent the volume falls, the present value will fall by a percent as well. And so 241,189. In percentage terms, what do I get? I get 2.21%. And again, although I hope I've made it clear, just think that through. If the sales volume fell by 2.21%, so too does the total contribution per year. And if that falls by 2%, discount for 15 years, the present value would fall by 2%, and 2% of it is 5329. We'd have got an NPV of 0. This time we're only worried if the volume falls, surely. If it increases, things are better and better. So strictly, we show the direction sensitivity is minus 2.21. Well, I think you should be getting the hang of it. But let's do the other. So about the contribution. This time, contribution is the only thing that's uncertain. Everything else is fixed. Again, say to yourself, if the contribution per unit changes, which of the present values will be affected? We'll show you exactly the same way as with the volume. If contribution were to fall by 10%, total contribution falls by 10%. Present value of it falls by 10%. Well, we can afford it to fall by 5329. So it's the NPV as a percentage of the present value that's affected, 241,189. And of course we've already done it. Again, it's 2.21%. It's negative. I'm only worried if the contribution per unit falls. Well, now it starts to, I think, get easy. What about the fixed costs? Again, we assume everything else is fixed. If the fixed costs change by 10%, 5%, 1%, if fixed costs change, the present value of them changes by the same percent. We can afford a change of 5329. It's the NPV over the present value of whatever changes, 87,705. In percentage terms, this time I get 6.08%. And which way possibly? This is a cost. So I'm only worried if costs go up. It's plus 6%. Again, if the fixed costs were to fall, the project gets even better. Only 2 left. What about the, what was it? The scrap value? Well, it's automatic. The present NPV, 5329, divided by the present value of the one that would change. Everything else now we assume is certain. It's only scrap that will change. And for every percent it changes by, the present value of it changes by a percent. So 5329 over 1845 is 288.8%. And we're only worried if it falls. Higher scrap value would give us higher NPV. Now, before I do the last one, In some ways, that would be meaningless, because normally, of course, scrap value obviously is an estimate. It could be less than 15,000, but normally the minimum would be 0. And even if the scrap value was 0, it disappeared completely. The 1845 would disappear, but the NPV would still be positive. And so really, you would say, well, it doesn't matter how much it falls. It's almost irrelevant. You'd say it's not sensitive at all. The only sense in which 288% could just be relevant is if there were a possibility that we might have to pay to scrap it. Maybe it's toxic and it's costing us money to remove it. Then the scrap could be negative, and then there would be a relevance, that 288%. All right, well, all of those I spent time hopefully explaining. I hope it's clear. But otherwise, it's very mechanical, and once you're into it, it's very easy. The only one that's a little bit different is the last one, the cost of capital. Because again, we assume we're certain now of everything except this time the cost of capital is 15. We think it's 15, but clearly, if it was higher or lower than 15, even with everything else being equal, the NPV would be different. Provided it's positive, the NPV, we're okay, but if ever it's negative, we're not. Break even would be an NPV of 0. So for this one, we need a different approach. I need to know what cost of capital would give an NPV of 0. And of course, from 2 or 3 chapters back, by definition, we're going to need to calculate the internal rate of return. So let's calculate the internal rate of return. The rate of interest that will give us an NPV of 0. And so a bit of revision here. For the internal rate of return, we make 2 guesses and then approximate. We've already got an NPV at 15. For the NPV to be lower, the interest must be higher. So any guess you want, but I'll make a second guess at interest of 20%. So the flows again. The cost was an outflow of 150. We've then got contribution of, in total, 15,000 times 275, 41,250 per annum. We've got fixed costs, 15,000 a year for 15 years. And we've got a scrap in 15 years' time of 15,000. So exactly as before, but this time let's discount at 20%. $150 is $150. An annuity, 15 years at 20%. The factor is 4.675. So the present values of the contribution, 192,844, and of the fixed, 70125. And finally, the scrap, the ordinary 20% factor for 15 years, 0.065, gives a present value of 975. So the NPV at 20% I get a negative 26,306. It's less, obviously, as I would expect, with a higher interest rate. The IRR, well, I spent enough time earlier showing how we calculate it. If you want to learn the formula, do. I'll do it the way I always do, though. I don't like learning formulae. 15%, the NPV was 5329 positive. At 20%, our second guess, it was 26306 negative. So over a change of 5 percentages, it fell from +5 to -26, a total fall of 31,635. So a fall of 30,000 equates to 5 percentages. The IRR, we know it's more than 15, but how much more? We want a fall of 5,000. We know a fall of 31,000 is 5%. So a fall of only 5,000 to 0 is this proportion of 5%. Which, as always, I hope I'm getting my arithmetic right. I get 15.84%. Which seems about reasonable. However, we haven't yet answered the question. The question wanted to know the sensitivity to change of the cost of capital. Be careful, people get muddled on percents. We think it's 15%, and at 15% the project is worth doing. If the cost of capital is lower, no problem. The project's even more worthwhile. But if the cost of capital is higher, a little bit higher, no problem. But if ever it's more than 15.84, then we've got a problem. So we can afford a change from 15, we can afford a change of 0.84 percentages on our estimate of 15. So we can afford our estimate to be wrong by 0.84 over 15, comes to 5.6%. Our estimate can be wrong by up to 5.6% of 15. If it changes by more than 5.6% of 15, then it's not worthwhile. And as I was saying earlier, we should show a direction. I'm only worried if the cost of capital increases, but there we are. Finally on this, and it does, it's basically what it says, advantages of sensitivity, or comments and advantages go with it. The relevance of sensitivity, you see. Remember, we think, back to the very beginning, we think that this project is worthwhile. It gives a positive NPV. But we do accept that all the flows are estimates, and if any of them change, potentially we could be making the wrong decision. Well, the sensitivity, surely the lower the sensitivity, the lower the percentage, the smaller the change we could allow, and the more worried we are. Here, fixed costs can change by up to 6%. You're never certain of anything. That's a reasonably big change, but contribution, if it changes by as little as 2%, the internal rate, the cost of capital, a change of 5.6. The point I'm trying to make is the lower the sensitivity, the more worried we are. Tiny change. You know, if the sensitivity was 80%, well, the chances of being 80% wrong in my estimate are tiny, no problem at all. If the sensitivity is 1%, then, you know, a very tiny change, and the project's not worthwhile. So the lower the sensitivity, we're more worried, and as a result, you'd spend more time trying to estimate more accurately. Try and estimate better. They're the ones you need to focus on, the ones with a low sensitivity. Say again, if sensitivity was 80%, well, I don't think I'd ever be that much wrong, so I won't waste any time. Sensitivity is 2%. I'll spend a lot more time checking my estimates and trying to be more certain. Or, of course, if the sensitivity of any of the items is low, then even though the NPV looks as though it's going to be positive, I might not take the risk. You know, I might say it's positive, but if these estimates, if, you know, 1% error would make it negative, I might actually say I won't do the project. So there's how we use it and what the advantages are. The disadvantage, the huge disadvantage, is that, of course, in real life, all the factors are uncertain at the same time. We look at each one separately. For each one, we say, oh, let's assume everything else is certain. But again, in practice, you know, if two of these change at the same time, a much lower change in both of them would affect the decision. And they may be interrelated. You know, volume and contribution. You know, the two may be linked because selling price may affect volume, you know, the last chapter. We only look at one item at a time. And as I say again, in real life, everything starts to be uncertain. Which actually leads me very, very briefly to the next bit, Monte Carlo simulation. This is something where you couldn't be asked to do any arithmetic at all. Just be aware of it. And without me reading through the stages, what it is, it sort of addresses the problem of sensitivity analysis. You would agree with me, I'm sure, that in real life, that last example we did, we think the volume will be 15,000 units a year, but it might be 10,000, it might be 15, it might be 20,000, and so on. We think the contribution will be $2.75, but it might be $2, it might be $3, it might be $4. Well, what you could do, I think, you know, you all know what a spreadsheet is. I could have a spreadsheet setting it up for every possible level of sales volume I could imagine. Every possible contribution, every level of fixed costs. So lots and lots of different combinations, and work out all the possible NPVs that could result. I certainly need a spreadsheet. There's no way I could do this on a piece of paper. But, you know, perhaps I think the fixed overheads would be 14,000, 15 or 16. Maybe I think the sales volume will be 14,000, 15,000, 16,000. So I could set up every permutation, lots of various outcomes, and if we could put probabilities to them, I'd work out all the different NPVs and look at the probabilities of the overall NPV ending up positive or negative, and make my decision on how likely it was to end up being positive. So I hope that makes sense. You've got the idea of it. I say you could never be asked to do it in exams, but just be aware of what it is. Monte Carlo simulation. Okay, we're not finished the chapter, but I'll pause there. In the next lecture, look at a couple of other things related to uncertainty.